2024 and car loans across the United States have reached a grand total of $1.6 trillion. To put that in perspective, that would take 8 Elon Musks to pay for all of it. How did we get to this point though? How did the average car payment in America for new cars get over $700 and average used prices get over $500? It all started in 1919 with the invention of the first auto loan. When General Motors Corporation established the General Motors Acceptance Corporation, or GMAC. GMAC is a response to the growing demand for automobiles among American consumers of World War I. Now, Ford thought the idea of car loans at this time was repulsive, and they decided to do a payment plan, like a layaway system. Ford's weekly payment plan failed miserably. Americans wanted fancy cars, ones they could buy on credit. General Motors overtook Ford as the leading car manufacturer, and by 1928, Ford Motor Company set up its own auto loan subsidiary. At this time, car loans were around 12 months and you needed 25 or 30% down on the car to be able to buy it. But that quickly changed, and over the next 10 to 20 years, things turned from 12 months to 24 months. And in the 40s and 50s, they created the lease programs that we know today. Car leasing as we know it started in the US in the 1940s and 50s. Some of the first leasing options were offered to businesses, but not the general public. The big boom of the leasing industry happened in the 1950s and 60s. This led the former president of Ford, Mr. Lee Iacocca, to invent the 36-month, which offered consumers a new Ford with a 20% down payment and a $56 payment over 3 years. So at this time, 3-year car loans were brand new to the market in the 1950s. And this was part in rise to suburban America and 2-car households becoming required to get to just to do daily tasks. Because of the car invention, households were able to move further away from city centers, and people liked suburbia. People liked having their own backyards and their own neighborhoods. So this was part of the reason. Additionally, women started to go into the workforce around this time, which emphasized the requirement to have 2 vehicles, vice one. This didn't last long though. By the 1970s, auto buyers are taking loans up to 48 months to meet rising prices. And of course, here they were trying to be very cautious about how they implemented the 48 months because there was some kickback in general with public and consumer thought process that this was getting too long of a loan term. And this is what really solidified car payment over car price. People stopped caring about the car price so much as payment, and it says so right here. I don't think price is as important to a buyer as his monthly payment. An auto executive said, if we can hold the monthly payment to a level he is used to, he doesn't care about the price. Still affecting the markets today. It didn't take long to get up to a 7-year loan in the 80s, which is only a decade later. We hate to see it, but car prices are getting so high that in a 7-year contract is the only way some people can afford them. Some Zoom finance and insurance manager at the Euro Motor Cars Incorporated in Bethesda. It was at this time in the 80s that 75% of GMAC's car loans were in 48-month terms, so we're about a decade behind. The other 25% were in longer term or leases. In 2008, there was arguments trying to get the 60-month term to be the maximum length a car loan could be, but the auto industry kicked back, saying a 72-month term has become the normal standard operating procedure, and that it would break us to be able to go down to those terms. To the Secretary of Exchange Commission, a collection of automotive finance companies argued against a proposed federal rule that would have made 60 months the maximum term for automotive loans. The group said the 72-month term has become auto standard, and that the critical American economy to allow banks to determine independently the risk as it relates to automotive loans. They argued that any mandated term limit would cripple the automotive industry. There is some upside to this. This is bleak, but there is some upside to this. The auto prices are cooling, but we're never going back to old normal. Experts say here's what car shoppers can expect. We're at $47,244 on average right now. We're almost $2,500 cheaper than we were in 2022, but we're still over 30% higher than we were in 2017 at $35,607. So what do I recommend you do in this situation if you need a vehicle? I recommend going to carcomplaints.com and looking at their best vehicles they have. These are the cars that have the least amount of complaints of them over the last few decades. You can see what is on the market that may fit your bill. Also, if you have something that does work right now, it's not needing extensive repairs that would cripple you, or try to save up, try to fix the vehicle you have. Those would be my 2 options. I want to show you real quick what the impact is on your savings account if you were to save just a few $100s a month for 15 years, which is the average lifetime expectancy of a new car. Instead of buying a new car, you could save this money for 10 years. You bought a 5-year-old car, save $300 a month. You'd be $61,400 $453 at 10% annually interest. This is just any S&P 500 index fund. You would be able to save $61,000 in 10 years. That'd be enough to buy any new car today. If you were to go to the full payment of $723, you'd have $148,000 after just 10 years of growth. And if you can only save a couple $100, you would still have $40,969, which is still enough to buy a Mazda 6.5 or something similar to that. If you were to do this even longer term, say 15 years, you could have $82,894, and this would just be an amazing thing for you to be able to say you have. This is not something that's hard to do. It's 10% is a very manageable return rate. It's very achievable. If you knocked it down to 9%, you'd get far less, but it's still $75,000 instead of $82,000. Or 8%, you'd get $69,000. Either way, over 15 years, you're still getting a great return rate. And if you get more than 10%, that's even a better ratio, but I try not to use higher than 10% because that may be unattainable. When I use rational, realistic numbers that I think you can get. It doesn't factor in inflation, but you're still looking at a great return on investment. And then you can buy cars forever brand new with cash instead of paying interest, and you're going to be up ahead of the system. If you wanted to do this every 10 or 15 years, you could buy them with your own money. Thanks for watching. Have a great day.